I'm an economics teacher. This is my classroom. Let's talk about the effects of the US tariffs for the average American. And so we're going to go over 3 different effects that you'll feel in a very real way. And then we'll talk about 3 strategies that you could employ to mitigate some of that risks that come with the tariffs. Okay, so in the short term, there is going to be price inflation. Now, this might be persistent over the long term as well, but I just want you to think through what a tariff actually does. Okay, so a tariff will increase the price of goods and services when they come into the economy for US buyers. Now, when you think about Mexico, Canada, China, a lot of these goods that are being imported are raw materials or in-process goods. So these are your metals that you need for manufacturing. These are your lumber that you need for building homes. These are grocery products, chemicals, all sorts of raw materials. And so you can imagine a situation where in order for US firms to deal with that increase in price, they're going to pass on some, if not all of those costs to their customers, to their consumers, to you, essentially. Okay, so prices will go up in the short run. In the long run, however, you want to think about a different effect, and that's an effect that is a consequence of losing international competitiveness in the market. And so why do we lose international competitiveness in the market? So you can think about how if something costs more to make, then you have to sell it for higher prices. And so the world doesn't only have 2 countries, right? Every country can buy different goods and services from all sorts of different countries. And so if the US now has to export a certain good or service at a higher price compared to other countries, then importing countries will pick countries that have cheaper goods. And so particularly in industries like manufacturing, right? Like American cars, for example, over the long term might lose international competitiveness compared to Chinese cars, who are already very, very cheap to produce. If there is inflation, then this will disproportionately affect lower to middle income households who spend a majority of their income on essentials. We already talked about how a lot of the prices that are going up will be in the categories of essentials, like energy, for example. Northeast United States gets a lot of their energy from Canada. In groceries, in housing costs as the price of lumber increases. And so this will not affect the super rich or the ultra rich or just even the moderately rich. And the reason is because a lot of these people own assets, right? They have investments in the stock markets. And so companies will continue to profit because companies are the one raising prices. You're the one paying those prices. And companies are also the ones paying salaries. And so salaries traditionally do not rise as quickly as prices. And so you probably have like a 2, 3 year, 5 year contract that dictates how much money you're going to be paid every single year, okay? And so corporate profits will continue to increase. And so if you buy assets, if you own assets, then your net worth will go up in this situation. Number 3, jobs. If you work in a sector that uses tariffed goods in the production process, your chances of facing unemployment are higher in a macro sense. So think through it with me. Your cost of productions have gone up. Your raw materials prices have increased. And so in order to remain profitable, companies will raise their prices for their final goods and services to the consumer. And so the consumer, as a result, will buy less, right? And so companies now require less people to make less goods. And so they are going to cut, right? They're going to lay off a certain group of people that they no longer need because they're servicing essentially what is a smaller market. Okay, and so that's in a macro sense. Are you in an industry that will be affected by tariffs? And number 2, in a micro sense, not everyone will be cut, right, from the company. Some people will stay. And so as kind of off and weird as this sounds, make sure you're the most productive, wall-like person on the team. That's really the best way to take advantage of the biases of humans in a micro sense. Okay, so those are 3 effects. What do we do? Okay, so three strategies. Number 1, make sure you own assets. So what will happen is, in order to combat inflation, the Federal Reserve is likely to cut rates. When rates are cut, there is inflation, because that's also going to be a time when a lot of borrowing will take place, right? So the Fed will continue to print money for the government, which, by the way, that budget deficit, the national debt, isn't going away anytime soon. If you think about how much is being added to debt every single year, it's about around $2 trillion, right? What about tariffs? Well, the estimated, according to, I actually have research on this, but according to the Royal Bank of Canada, they did a research on the amount of government revenue that the tariffs will bring in, and that's only just going to be about $300 billion. That doesn't include the fact that demand for imports will decrease, so the number is likely to be lower. And it also doesn't account for the tax cuts that Trump has planned. Okay, so the national debt isn't going away anytime soon. And so more debt, in fact, more debt will be needed to finance the government's operations. And so the answer is inflation. The gap between the rich and the poor will continue to increase. And so when there's inflation, asset prices increase. So these are your stocks, right? And so it's very important to make sure you're invested in some kind of portfolio, like an S&P 500 index fund, to make sure that you capture some of those gains as inflation increases. Okay, so number 2, you want to make sure you have an emergency fund. We are looking to be in a recessionary environment in the next, I don't know when, but like it's coming in the next few years. All the indicators point towards a recession, and there's higher uncertainty, especially if you're in a tariff-affected industry. And so if you have a 6-month emergency fund, sure, that works, but the way I want to think about emergency fund is how much longer would it take for you to find a job if you were out of one. So make sure you have an emergency fund that can sustain you and your family's lifestyle through those tough times, whether it's 3 months, 6 months, or even a year's worth of emergency funds. Number 3, I want you to start thinking about other places you could work in and retire at that might be outside of the United States, because being tied down to one location increases risk. There's actually a whole study on this in the realm of land economics. It's a concept known as geographic discontent. And it's when people are unhappy because they are stuck in one place and they have no means to move. And in a world where we are connected by the internet and where people are making money online and where your skills are probably valued overseas as well, and in a world where you can acquire skills that could be valuable overseas, I think there is good reason to decrease your risk and diversify away from your geography. Like and subscribe if you found this interesting. In this channel, I will continue to go over how you should be navigating in the current economic environment as an investor and as someone that wants to create the best life for themselves and their families.